Hello, welcome to Zooming in China. I'm Simone Gao. On the final day of June, ride-sharing giant Didi Global, China's equal to Uber, made its initial public offering on the New York Stock Exchange. This listing had been years in the making, with industry insiders whispering about such a move nearly 5 years ago. But once the decision was made, the filing and approval moved at lightning speed, with help from U.S. bankers backing the listing, including Goldman Sachs, Morgan Stanley, and JP Morgan Chase. For the first 2 days, Didi's IPO was a global success, emerged as the largest Chinese IPO on the U.S. stock market since Alibaba's offering in September 2014. By the second day, Didi's shares rose 16%, leading to the valuation of the company at about $80 billion. Then came the international firestorm. The Chinese government, taken by surprise by this public offering, struck back quickly. The Cyberspace Administration of China, or CAC, announced on July 2nd that Didi would be placed under cybersecurity review. During that review, new users would be banned from accessing the app, 25 of the company's other apps, accusing them of violating laws surrounding the collecting of personal information. On Sunday, the CAC announced that the Didi app would be removed from all Chinese app stores. Following the announcement of that review and a restriction by the CAC, investors left in large numbers, leading to a 5% drop on Friday and a 25% drop when market opened on Monday morning. While the stock has recovered some of those losses, it still sits well below its success prior to the CAC review. At its core, this is a conflict over data: who has it, who controls it, who can access it, and how it is used. Despite operating in 16 countries, most of Didi's business comes from China, where it controls nearly 89% of the rideshare market. With a market that size comes massive amount of data, including sensitive data displayed on its map function. Even after the CAC ban, Didi has 377 million annual existing users and 13 million drivers who are still able to use the app. After the early June public filing, Didi set a goal for early July initial offering because they are incorporated in the offshore tax haven. They were not required to seek government approval for the overseas public offering. Still, Didi informed China's National Development and Reform Commission and Beijing cyberspace regulators of their intent. Chinese regulators urged Didi to pause the offering over concerns that IPO documents required by the U.S. regulators could provide sensitive Chinese data. One point of concern may have been the U.S. law passed last year named Holding Foreign Companies Accountable that requires Chinese companies to turn over audit documents, including original accounting books, for regular review. Even though that law was not fully implemented before July 12th, which has already passed Didi's IPO date, the Chinese authorities worried about documents submitted after the company's IPO, since the U.S. regulators would review audit documents every year. Back to Didi. So Didi did not commit to postponing the sale, saying only that they would consider the Chinese regulators' request. Government officials claimed they did not intend to block the sale, but wanted a chance to review Didi's records. But rather than pause the IPO, Didi sped up the process, setting a sale date for June 30th. It is not clear why Didi chose that path. One speculation is that Didi tried to finish the IPO procedure before the Holding Foreign Companies Accountable law was fully implemented, so they didn't have to provide sensitive documents required by the new law, at least for the IPO. Didi's only public statement has been that they were not aware that Chinese regulators would place them under review. But there is reason to believe that Didi was also concerned about regulators blocking the sale, and they had good reasons to be concerned. The Chinese government blocked the Shanghai and Hong Kong IPO of the Ant Group last November. expected to be the largest IPO in their history 2 days before trading was to begin. And as several Chinese tech executives have said, despite the regulatory pushback from Beijing, this would likely still be a win for Didi. The CCP has not taken this loss of control well, though, and the reins placed on Didi have been added to other recently listed companies as well. Full Truck Alliance, an Uber-like service for freight trucks, who had their U.S. IPO on June 22nd, and Kanzhun, an online job recruitment service whose IPO was 1 day later, have now been ordered to reject new user registrations and submit to a cybersecurity review. A tightening of CCP's control over the Chinese tech sector has been a long time coming. After the debacle with Didi, that control is growing. On Saturday, the CAC posted a proposed revision to their cybersecurity review measures on their website. The revised measures would compel companies with more than 1 million users and those newly listed on foreign markets to secure CAC approval and turn over IPO materials for review before listing shares in those markets. The CAC has made that proposal available for public comments until July 25th. Though public feedbacks will mean very little in CCP-controlled China. Because Didi has been classified by Chinese law as a critical infrastructure provider, they are viewed as holding national security level data. The revisions to China's cybersecurity law make that clear, nearly all of them centering on the holding and transmission of data. To the cybersecurity law of the People's Republic of China, they have added Data Security Law of the People's Republic of China. The earlier law applied only to those procuring network procedures and services, but will now also apply to data handlers, conducting data handling activities that influence or may influence national security. As part of that review, companies will have to provide a written declaration and analytical report on the possible influence on national security, a procurement document, agreement, or contract to be signed, and the IPO materials provided for submission. Publicly, the CAC says their concerns are that core data, important data, or large amount of personal information might be stolen, leaked, damaged, or illegally used or exported, and that the data of Chinese companies could be affected, controlled, or maliciously exploited by foreign governments once listed. What they are not saying, though, is that they are equally concerned with the power and position their online platform giants like Didi will gain through these added investment. These Chinese tech giants are simply not allowed to exist like before. Their power has to be reined in. As Chinese companies grow more powerful, they become a direct threat to the regime, and the CCP has consistently squashed any threat to its power. But T.S. Lombard's expert on China's economy, Rory Green, wrote in a recent note that crackdown on Didi opens a new front in China's tech assertiveness. This is a question of sovereignty. The battle for data sovereignty is beginning, and China is already fully motivated. It is not clear how long the crackdown on Didi will continue, nor how many future Chinese companies may be affected. What we do know is China's online platform economy has joined big tech under the hawk-eyed watch of the CCP regime, as China continues to strong-arm the giants of their corporations, including Didi, Ant Group, and recently even Tencent. When they attempted a merger the CCP believed would give them too much power in their sector. Are we going to see a China that will go back to the old days of the planned economy where the government controlled everything? Let's wait and see. Thanks for watching Zooming in China. Please like, share, and subscribe to our channel if you like our production. Most importantly, please sign up for our membership website, zoomin.tv, $5 a month, and you can cancel anytime. We have video audio formats of our show, in-depth report only for the members, and live Q&A with me on the website. Thanks for watching. I'm Simone Gao, and I'll see you next time.